The markets are looking stellar. Is the Santa rally over? During these last few trading days of the year, we could see some last-minute tax loss selling that appears to have already started. This applies to equities and long bonds. Last week I said the bottom dynamics weren't showing a clear direction, while the other metrics were looking like we could see a rally. I'll put a link to that video in the pinned comments below, so you can watch it if you're interested. And if we look at what happened to equities this past week, you can see they all closed the week higher. This is a very healthy looking appetite for risk here. What about over the past month? Well, if we look over the past month, you can see again a very healthy risk appetite with the highest risk equities, ARK, small caps. Unfortunately, the NASDAQ's been taking kind of a breather, so it's not in third place, but the Dow is in third place and the S&P is in last place. But this is a very healthy looking risk appetite. And what if we look at year to date? Well, year to date, you can see it's just everything's been on a tear. ARK is well above its previous high for the past year, or at least year to date. The NASDAQ is also above its high year to date. The S&P is above its high. Small caps are above their high, or yeah, it's kind of hard to tell, but they're close, if not above it. And the Dow is above its high. So this is very, very healthy looking. And I'm going to go back 5 years. And why am I doing this? Well, if you look back at my videos in late 2022, early 2023, I think it was late 2022, you can see that back here, ARK Invest was selling for less than it was 5 years ago. And I know I said that in several of my videos. Well, if you had been genius enough to buy it, you would be up. Let's go back here and look at year to date. If you had been genius enough to buy it back here, at the end of last year, beginning of this year, you'd be up 74%. That's a crazy increase. This looks great. I'm afraid to say how I feel. Now let's take a look at the bottom dynamics. And what I said last week, when we were looking at this last week, you can see that the bottom confirmation was flat. The bottom forming indicator was flat. And if you remember from last week, the confidence level looked a little bit flat. So I said there was absolutely no tell here. So I wasn't going to make a prediction based on this chart. And I didn't. Not based on this chart. I said based on the other factors that we look at, it looked like it could go higher. And in fact, that's what happened. You can see that here. We've moved slightly higher. But what if we look at this week? Well, we have a flat bottom confirmation and a flat bottom forming indicator, and confidence levels falling slightly, but it's not really going anywhere. So this tells me we've really got a non-committal market going into the year end here, and that could be for a lot of reasons. Tax loss selling could be part of it. You just don't know. And what if we look at risk versus opportunity? Well, this couldn't look better, honestly. You can see that risk acceleration is down here below 10. And you'll remember back here I was saying as risk acceleration drops, risk is going to follow. And you can see it's absolutely collapsed here. It's down below 50. This couldn't look better. And if we look at the opportunity level, not only is it above 70, but it's rising. This looks really, really positive going forward. And what about equity versus safety? Well, equity versus safety looks stellar. And you can see that here. Let's take a look at the NASDAQ 100 and how that's been doing. So if we plot where the NASDAQ 100 has been, you can see that it was up here in first place. It kind of took a breather here and dropped down to 7th place. But since then, it's gone up to 6th and now is in 5th place. So it's moving in the right direction. It's a higher risk investment than, let's say, the S&P or the Dow, and it's moving higher. What about small caps? Well, if we look at small caps, you can see that they're still in 2nd place up here. This is a very healthy risk appetite. Now, let's follow the cash as we always do. And you'll remember last week I said, I have no concern that cash moved from 9th place up to 8th place, and it stayed in 8th place. Now, why did it move from 9th to 8th? Well, you can see what gold did. Gold has been really underperforming cash. So it pushed cash up here. And now you'll look at this week, and gold moved down even further, pushing short-term treasuries up into ninth place. So I have no cause for concern with cash and short-term treasuries and intermediate treasuries all being down here. This shows a very healthy appetite for risk. And what if we look at safety assets? Well, we looked at cash and we kind of looked at intermediate and short-term treasuries, so we'll kind of ignore those. But look at the long bonds. EDV, the longest duration treasuries, are still in first place. Now, you'll see when we look at treasuries, it looks like there might have been some tax loss selling in these on Friday. But boy, these are looking great. And 20-year bonds are up here in third place. This is a very healthy appetite for long duration bonds. And you'll see that they've performed very well and still have potential upside. So how does all of this show up in the buying and selling pressure for equities? Well, if we look at the Dow, it's kind of flat topped a little bit here, but the buying pressure is still well above the selling pressure, even though it's rolling off here. The S&P 500 has continued to move higher a little bit, but you can see that the buying pressure has really fallen off here, and the selling pressure is starting to come up. And then if we look at the NASDAQ, this looks great. Remember, it took a breather back here? Well, it's in rally mode again, and you can see that the buying pressure is not only well above the selling pressure, but as of Friday, it's moving higher. This looks great. Now, what about ARK Invest? Well, ARK Invest kind of took a breather here, not much of one, and has continued rallying higher, but the buying pressure has really fallen off here. So interesting to see that happen. Not sure what that's about. And if we look at small caps, similar picture. Super rally here, just stellar. But the buying pressure is falling off and the selling pressure is rising. Maybe this is due to some tax loss selling in small caps going into the end of the year. Now let's take a look at sector rankings. These look fabulous. And you can see that last week, cash was down here. We had gold up here, but you can see that ARK Innovation was up here, Bitcoin and technology up here, the NASDAQ 100 up here, semiconductors. This is a very, very healthy looking risk appetite, although 20-year treasuries were down here. Well, let's fast forward to this week. If we look at this week, 20-year treasuries have moved up here, as you can see in the other charts we've looked at. Consumer discretionary has moved up. Cash has moved down. This is great. And you can see that gold has moved down, as we saw in equity versus safety. Now, what about higher risk assets? Well, ARK Innovation moved up again. It's up here in second place. Bitcoin's still at the top. We've got all the higher risk technology indices and ETFs up here. This could not look better, and consumer discretionary has moved up. So this looks just great. Now, could there be some bad news in sector rank acceleration? Remember, these tend to show you kind of where things are headed, whereas the sector ranks tend to show you kind of where they've been. Well, let's take a look. You can see that last week we had 20-year treasuries here. We had ARK Innovation up here at the top, consumer discretionary here, cash all the way at the bottom, and gold way down here. Now, what's happening this week? Well, if we move to this week, ARK Innovation's still at the top. Semiconductors have moved up into second. We've got 20-year treasuries moving up another notch. This is good. But consumer discretionary has dropped back a bit, while consumer staples have moved up. This could be some shifting of assets away from higher risk equities into safer consumer staples. But again, this could be a year-end move. No way to tell where this is going to go. Cash has moved up one, but only because gold has displaced it from the bottom. So in general, this is a very, very healthy look here. Now, the NASDAQ 100 has pulled back a bit too, which is kind of in line with consumer discretionary. I'm really not concerned here. Let's see how this starts out next year, into the next year, before we make any judgments. And what about treasuries? Well, if we look at treasuries, you can see, it looks to me like there was some serious tax loss selling on Thursday and then again on Friday. in the very long duration treasuries. Now, why would you have tax loss selling? Well, you can see that all the other treasuries look fairly healthy for the week, except the very longest duration treasuries. If we look back over the last month, this is fabulous. I mean, these are equity returns. These are not bond returns. These are safe haven assets. And you can see at the long end, they're up 13, almost 14% for the month. This is crazy. But if you look back over the year to date, these longer bonds are still underwater. So investors who bought them back here, especially at these higher levels, are going to be dumping them going into year end so they can claim those tax losses in their taxable accounts. Now, after they're done doing that, is there opportunity for this to go higher? Well, let's take a look at the last 5 years. And if you look at the last 5 years, these things are still very, very underwater compared to where they were 5 years ago, and certainly compared to where they were during the pandemic time. Now, do I expect them to get back to here? Not unless there's some major thing that goes wrong and the Fed drops rates to zero again, which I really hope doesn't happen. But even if that doesn't happen, just for them to get back to where they were in 2019, while the world was just fine, they still have got to go up a lot. Look, they're down here. They're down 28.58% from where they were 5 years ago. If they just get back to even, they have to go up almost 50%. Not quite, somewhere in the 40s. But my God, for a safety asset like bonds, that's a huge potential return. I wouldn't be selling them here. And how does all of this show up in the buying and selling pressure? Well, you can see that for short duration treasuries, the buying pressure is still well above the selling pressure, although it's heading in the wrong direction. But the price action's great. Similar with intermediate treasuries, upward price movement, but the buying pressure is collapsing. Selling pressure is coming up and will soon surpass it. What about 7 to 10-year treasuries? Well, buying pressure just collapsed. And again, this could be due to tax loss selling. And then if we look at the long bond, you can see the same picture. Prices have declined a bit, and the buying pressure has really collapsed here. So this could be due to year-end tax loss selling. And what if we look at that inverted yield curve? Well, let's take a look. If we look at the inverted yield curve, you can see what's caused the rally in long bonds. Just a month ago, the rates on long bonds were way up here, and now they've fallen way down to here below 5%. So you can see there's a drop in the yields at the long end, while at the short end, the interest rates have stayed somewhat stubbornly high. Why? Because the Fed controls these, and the Fed has not started reducing rates yet. Now, how does the market feel about what the Fed's going to do when they meet at the end of January? Well, you can see that most of the market tends to think that the Fed's going to leave interest rates unchanged when they meet at the end of January. But there's a growing percentage of the market that feels they might actually lower rates. Let's take a look a little bit further out in time, though, and see how that looks going forward. So if we look at the Fed rate monitoring tool, you can see this is where things sit for the next meeting on January 31st. But let's roll out to March. And if you look at March, now all of a sudden, the majority of the market thinks that the Fed's going to lower by 0.25%. The blue line is where interest rates are right now, and this is where the market thinks they might go. Now there isn't even a blue bar here. The market in its entirety believes that the Fed is not only going to lower interest rates by 0.25%, but is likely to be down by 0.5% by then. What if we go into June? This is really getting interesting. So now they're talking about a 0.75% reduction in interest rates. And if we go into July, it just keeps getting better. So the markets firmly believe that the Fed is going to be reducing interest rates into 2024. Is the market right? Well, maybe, maybe not. I mean, nobody has a crystal ball. And so we'll see what happens with this. And what about gold? Well, yeah, gold has been kind of waffling here. And you can see it had a great rally here, pulled back. It looks like it's in rally mode again, but the buying pressure is declining while the selling pressure is coming up. There's not much of a tell here. Don't really know where gold's headed going into next year, but we'll just have to wait and see. And how about Bitcoin? Oh my God, look at this. This rally has just been stellar. And not only is it stellar, look at it's pointing even higher. The slope is increasing here going into the end of the year, and the buying pressure is shooting straight up while the selling pressure is collapsing. Hopefully this portends great things for Bitcoin, not only going into the end of this year, but going into next year. As you can see from the metrics and the charts, there's a very healthy risk appetite showing in the markets, not only in the equity markets, but in the bond markets and in the crypto markets. This looks just great. I hope you all have a wonderful Christmas if you celebrate it. Hanukkah came and went, so your 8 days of stock market gifts is over. Look, as an investor, you need to take the long view and allocate according to your risk tolerance rather than fretting about what's currently happening in the world that could turn the markets upside down. If you want to be a better investor, I discuss how to allocate your portfolios in 2 key videos linked in the pinned comments below. One is titled The Ideal Portfolio Using Just 2 ETFs or Mutual Funds, and the other one is The Ideal Portfolio Using Individual Equities. Again, link in the pinned comments. Until next week, I'm Calvin Rose, and thank you for watching Invest Smarter. That's all for now.